This lecture covers long-term financial planning. I'm your professor, Dr. Stephen Haggard. First, let's cover the answer to the question, what is long-term financial planning? Recall that we defined current assets and current liabilities as things that we're going to turn into cash or require cash within a 1-year time period. Everything beyond that 1-year time period is considered long-term in finance. The technique that I'm going to demonstrate in this lecture is for planning 1 year into the future. Now, it's important to know that financial planning follows in the wake of strategic planning. Financial planning does not happen in isolation. Let's talk about the strategic plan. Managers have to make decisions about future product and service directions for the firm. How does this process work? Well, usually you get everyone together from the different areas of the firm, including marketing, engineering, accounting, procurement, and so on. And you'll have a large meeting. And marketing will start out by identifying the areas they've found for growth in the sales of existing products and potential markets for new products. Engineering will provide guidance on the technical feasibility of these new products. Not everything that marketing identifies as desirable by the market can actually be executed using today's technology. That's where engineering comes in and tells what can and can't be done with current state of technology. Now, assuming that the product is technically feasible, then accounting and procurement can come in and provide cost information based on engineering input. Not everything that's technically feasible is useful for the marketplace because the cost of doing it may be so high that people would not be willing to pay it for the good they get out of the product. Using all this input, then, managers decide which new products to introduce and which existing products should have their production levels raised. Also, they'll probably decide which products to cut from their offerings because some products at the end of their life cycle are no longer producing profit. And these increased sales that come as a result of new products and raised production of existing products might require increased assets if the company is running at full capacity or the new products cannot be produced using existing assets. For instance, if you come up with a new product that uses entirely different technology than what you've been doing previously, even though your existing assets aren't running at full capacity, you may need to get new assets to produce the new products because of the new technology. Now I'd like to share with you a real-world example from my experiences at Americhem. Every October, everyone in a decision-making capacity at the firm, whether that be engineering, management, marketing, or sales, would get together for our annual strategic planning session. And the marketing people would be the first to speak because marketing people are aware of the market, they're aware of new opportunities in the market, they're also aware of which of the firm's products might be becoming obsolete and need to be discontinued or replaced with a newer product. They're also familiar with new geographical markets that might be opening up. The first example I'll tell you about is a decision we made to go into the Chinese market. To be able to compete in China, you really need to manufacture your product in China because of the labor cost differences between the US and China. So even though our US plants were not operating at full capacity, we still made the decision to build a new plant in China. And so we invested millions of dollars and sent several people there into a culture that was vastly different than their own to make this Chinese operation a success. We also made a decision to move into the automotive sector. We were already somewhat in the automotive sector, but we were having difficulties meeting the quantity and quality requirements of automotive plastics suppliers. And so we decided to build an entirely new plant using new technology to produce these automotive color concentrates. Because it was new technology, even though our plants were not operating at full capacity, once again we made the decision to build an entirely new plant. As time went on, the automotive business began to slack off as American automakers started to lose market share to foreign competitors. As a result, we ended up with spare capacity in our automotive plant. But the good news was that the same technology used to make automotive color concentrates could be used to make color concentrates for packaging like soda bottles. And so we decided at our next strategic planning meeting that we would enter into that market. And we set aside millions of dollars for research and development to develop new products for that market. The strategic planning process also identified on a rough annual basis what we thought our growth in sales were. So for the products that we already had, we had an idea of what our sales for those products for the coming year would be, and we could plan our assets accordingly. Next, we'll talk about the financial plan. The financial plan follows the strategic plan. Recall that in the strategic plan, we figured out what product areas we wanted to increase production in and what new products we wanted to make. And the financial plan is all about how we're going to finance the new assets that are needed to achieve that strategic plan. Now, there are basically three sources of money that we can get to fund our new assets. First of all, there's internal equity. If we earn money and we don't pay it out to shareholders as a dividend, then we can use that money for investment in our new assets. And then there's external equity. We could actually issue additional shares in the company and use the money that we receive in exchange for those shares to fund our new assets. And then finally, there's debt. Now notice that I've got external in parentheses there. All debt is external unless you get into a corporation where a conglomerate where you have divisions and the individual divisions can borrow from the parent company. But we're not going to think about that. We're thinking about a single company here that any debt that company might raise will come from the outside. Now we're going to introduce you to a simple financial planning model. All these financial planning models start with sales growth from the strategic plan. And we start out by making the assumption that our assets are currently at full capacity. That means we couldn't make another single unit of whatever product or service it is that we provide without adding additional assets. We'll relax that assumption later, but for right now, we'll start with that. We also assume that the assets grow at the same rate as sales. In other words, if we currently have 5 plants and they're all running at full capacity, in order to increase our sales by 20%, we would have to build one more plant because 20% of 5 is equal to 1. So 5 plus 1 would give us 6 plants. We're going to use that assumption to determine the new level of assets needed to support the sales. Then we'll determine what the addition to retained earnings are in the new scenario. This is our internal source of equity. Remember that net income flows to 2 places, dividends and addition to retained earnings. And we can use that addition to retained earnings to fund our new assets. Then we're going to determine the external financing needed, or EFN. And we're going to do that by looking at what is the increase necessary in assets, and we'll subtract out the addition to retained earnings that we just calculated. And then finally, we're going to determine whether that EFN should be raised as debt, equity, or a mixture of both. The answer to that question will depend on what kind of assumptions and constraints have been put on us. The best way to learn about external financing needed is to work several examples. The income statement and balance sheet that we show here are going to be the base scenario for all the examples we work today. On the left-hand side, you'll see the income statement. We have sales of 1,000, costs of 800, which gives us a net income of 200. This is very simplified. We're also shown that net income flows half into dividends and half into addition to retained earnings. Remember that addition to retained earnings is going to be our source of internal equity for investment in our new assets. Speaking of assets, we currently have 500 in assets. and we have 250 in debt and 250 in equity, which add to 500. This is not a coincidence. We will see that the assets and the sum of liabilities and equities must always be the same when we finish one of these examples. If they are not, we've done something wrong. And finally, from our strategic plan, we know that the forecasted sales growth for next year is 20%. In our first example, we have been instructed to grow the company while maintaining a constant debt-to-equity ratio. Notice that this constraint doesn't give us any information about the dividends in the addition to retained earnings, so we've blanked them out for now in the income statement. The next thing that we do is to increase the sales by the percentage of growth from the strategic plan. The strategic plan tells us sales are going to grow by 20%. How do I increase sales by 20%? Well, I multiply by 120%, or 1.2, to get 1,200. Now if I assume that the profit margin remains constant, I can also raise costs by the same proportion. So I also multiply 800 times 1.2 to come up with 960 in cost. Net income, because profit margin remains constant, increases by the same proportion as well. Notice that there's two ways that I could get the 240 from net income. I can either multiply 200 times 1.2, or I could subtract 960 from 1200. Either way, net income is equal to 240. Once again, we have no information how that's split up between dividends and addition to retained earnings, other than to know that dividends and addition to retained earnings are going to have to add together to be 240. Continuing with our first example, we must now increase the assets. If we assume that we were running at full capacity beforehand, meaning that we couldn't produce another single unit of the good or service without additional assets, we can make the assumption that the assets have to grow at the same rate as sales. And so that's what we've done here. We've multiplied our assets of 500 times 1.2 to come up with 600. Now notice that the assets and the debt plus equity no longer are equal. This cannot be. We cannot allow the situation to remain. Otherwise, our balance sheet wouldn't balance. We're going to have to add something over here on the debt and the equity side to make these things balance. That's the money that will be needed to finance these new assets. Given that we know that the sum of debt and equity has to equal assets, and that we know we need to maintain a constant debt-to-equity ratio, we can now figure out how much debt has to grow and how much equity has to grow. Now, here's a hint. They'll have to grow by the same proportion or the debt-to-equity ratio will not remain constant. For instance, right now the debt-to-equity ratio is 250 divided by 250. That's a debt-to-equity ratio of 1. And so we know that in the new situation, we will have to also have a debt-to-equity ratio of 1. We also know that debt and equity will have to sum to 600. What number plus what number would equal 600 such that when you divide that number for debt by the number for equity that you get 1? Well, 300. All we have to do is divide our new amount of assets by 2 to come up with the amount for debt and the amount for equity given our constraint of constant debt to equity ratio. Now, I've shown some algebra down here below for those of you who prefer to think in that way. I've written that out so you can see another possible way to solve for this situation. Now that we know how much debt and equity each need to grow, we can figure out our external financing needed. First of all, we know that debt must grow from 250 to 300. That means we need 50 in new debt. If you recall from earlier, all debt must be raised externally. So that 50 in new debt will definitely be part of our external financing needed. We also know that equity must grow by 50, but we have an internal source for the equity. Remember that net income flows into dividends and addition to retained earnings, which is our source of internal equity? Since net income is greater than the additional 50 that we need in equity, we can select 50 for addition to retained earnings and subtract that from 240 to find dividends of 190. This number that we allow to float to make the math come out right is called the plug variable. In this case, it's the amount of dividends that we pay out. In other cases, we may see the debt float or we may see the equity float, depending on what constraints that we've been given. Given that all the equity comes from internal sources, the only external financing needed in this case is the 50 in new debt that must be raised. Therefore, EFN equal 50. In our second example, we are told to grow while paying out no dividend. We know that net income flows into two places, dividends and addition to retained earnings. So, if we pay out no dividends, that means all of our net income is going to flow into addition to retained earnings. We start this example exactly the same as we started the last one, by growing sales and costs at the same rate as the overall sales growth. Because of the constant profit margin assumption, net income grows by the same proportion, and we wind up with 240 in net income. Since we're paying 0 in dividends, that means we're going to have 240 in addition to retained earnings. In this, as in the last example, we assume that the plants are at full capacity. Therefore, the assets must grow at the same rate as sales. We've already boosted up the assets here by 20% to 600. We also know that the debt and equity must sum to 600. And finally, we know that 240 in addition to retained earnings will flow directly to equity. Equity was 250. We've added 240 for a new total of 490. How much must our new debt level be? Well, the debt and the equity must sum to 600, so all we need to do is subtract out our 490 in equity from 600, which gives us 110. Now, if you recall, our old level of debt was 250. How do we get debt to go from 250 to 110? Well, we pay off 140 in debt. When we raise debt, that's considered positive external financing needed. What do you think happens when we pay off debt? Our external financing needed at that point is actually negative. 110 minus 250 is equal to minus 140. Example 3 is based on the same base scenario, but assumes that we try to maintain a constant dividend payout ratio while growing at 20%. The first step is to set up our income statement just like we had before, multiplying everything times 1.2 to account for the 20% increase in sales. Now the dividend payout ratio from previously was 100 divided by 200. After all, dividend payout ratio is dividends divided by net income. And so the dividend payout ratio was 0.5. So that means in the new scenario, we also need to pay out half of our net income in dividends. So we see that the new level of dividends is going to be 120. And we know that net income flows to dividends and addition to retained earnings. So the remainder of that net income must flow into addition to retained earnings. 240 minus 120 is 120. As in the two previous examples, we assume full capacity, which means we need to grow the assets at the same rate that we grow sales, which brings them up to 600. Now we know that debt and equity also have to add to that same number. And so we know that our debt plus equity is going to be 600. We know also what the equity is going to be in the new scenario because we know that previously equity was 250. And now we're going to add that 120 in addition to retained earnings to make our new level of equity to be 370. Knowing that our total assets are 600 and our equity is 370, we can easily find that our debt level is now 230. Previously, the debt level was 250, which means we have to pay off 20 in debt to make the new situation come out right. In this case, external financing needed would be minus 20 because we are paying 20 outside of the organization. And this makes debt the plug variable because we let it float to make the scenario work out. Continuing with example 3, let's discuss a common mistake that students make. Students think that when you pay out that 20 in cash that it's going to reduce the assets from 600 down to 580. In truth, if we didn't pay out the 20 in cash, assets would rise to 620. Let me prove that to you. If we don't pay off the 20 in debt, that means we still have 250. We have 370 in equity, and you add those two numbers together and you have 620. And so we know that that has to be the same as the total assets. And so what we'll have is an extra 20 in cash that we don't need if we don't pay the 20 out. Our shareholders will most likely be upset with us for holding extra cash because we will be earning very little money as a return on their investment, and they have a much higher required rate of return for our shares than we can make down at the bank on our spare cash. Example 4 starts with the same base scenario but now has two constraints. The first is that we'll be paying a set dividend, and the second is that we'll be maintaining a constant debt-to-equity ratio. The set dividend that we are told to pay by our board of directors is 200. So we start out like we always do, inflating our income statement by the same percentage as we plan to grow sales. And that gives us net income of 240. Now if we're required to pay out 200, that means that only 40 is left over as addition to retained earnings to be added to our equity. As in our previous examples, we assumed that our assets were fully utilized in the current period. So planning going forward, we need to grow the assets by the same percentage as sales, and that brings our assets up to 600. And that lets us know that our debt plus equity must also equal 600. Now the equity is going to rise by 40 from 250 up to 290. But if we're going to maintain a set debt to equity ratio, we need to have both debt and equity equal to 300. So we have 290 after addition to retained earnings. We need to raise an additional 10 in external equity. We would do that by issuing stock. As far as debt goes, we need to raise 50 to take it from 250 up to 300. And so our external financing needed in this case is actually 60, 10 in equity and 50 in debt. So far in each of these examples, we have assumed that we are currently running at full capacity. But what if we are not running at full capacity? For example 5, we are going to assume that our current level of sales represents only 90% of full capacity. There's a little equation here to help you out. Sales is equal to fraction of full capacity used multiplied by full capacity. We need to rearrange that equation to solve for full capacity. And we do a little algebra and find out that full capacity is equal to sales divided by the fraction of full capacity used. Our current sales number is 1,000, and we are using 90% of capacity. 1,000 divided by 0.9 is equal to 1,111.11. Actually, that 1 just keeps repeating forever, but we'll shorten it to 2 decimal places here. Next, we're going to find out what percentage increase our new sales level represents over full capacity. Recall that we said full capacity is 1,011.11. Our new sales level is going to be 1,200, which is simply 1,000 raised by 20%. We find that percentage by subtracting out full capacity from our new sales level and dividing by full capacity. So we take 1,200 minus 1,011.11 and divide by 1,011.11. That gives us 1.08. This represents an 8% increase over full capacity. So in this case, we don't really need to grow assets by 20%. We only need to grow them by 8%. What does that mean for our asset level? It should be 500 times 1.08, which brings us to 540. That's what's needed to support our new sales level. The remaining steps of these problems are the same after you figure out what this new percentage increase in assets needs to be. The previous example assumed that taking your operation up to full capacity was a desirable thing. In fact, I advocate keeping some slack capacity. In other words, not running at your full capacity all the time. Though it sounds like it would be more efficient, it actually causes problems. And here's why. First of all, we live in an imperfect world. My workers would scrap a piece of material and we would have to start over. If I were running at full capacity, I would have no capacity left to remake that part. Also, on occasion, my machines would break down. And if I were running at full capacity, I would never get caught back up. And in those cases, you either need to make the decision that you're going to be late on every order from here till the end of time, or you decide to wrong the people who are next in line and only work on orders that you know you can make by the deadline. Neither one of those things are desirable. So I always like to leave some room for breakdowns. Running at 80 to 90% seem to work well for me. Of course, it will vary based on what business you're in. And then finally, being able to take on surprise orders. There were times when people would call in from the Gulf of Mexico seeking one of my safety valves, but they needed it in a hurry. If I put them into the normal production queue at full capacity, it would have been weeks before I could have delivered the valve. Rig time in the Gulf of Mexico at the time was $250,000 per day. So for every day I could save them, it saved them $250,000. And so they were willing to pay quite a bit to get that product faster. So I might be able to sell the valve for 2 to 3 times its normal value simply because I was saving them so much money by getting them the valve in a short fashion. If I'd been running at full capacity, I would not have been able to take on such orders, and I could not have picked up the profit that was associated with them. Now that we've worked several examples, let's try to summarize how you should approach these EFN problems. First of all, we need to forecast the sales growth. This comes from our strategic plan. And then we need to increase our sales and our costs by the same proportion. The implicit assumption here is that you have a constant profit margin. Second, we need to note capacity utilization and constraints like dividend payout policy and capital structure policy. These statements will say things like, we are currently utilizing 90% of our capacity, you must maintain a constant dividend policy, or you must maintain a constant dividend payout ratio. And for capital structure, might say something like, you must maintain a constant debt to equity ratio. These are all important things to note. The third step is to determine how much new equity comes from addition to retained earnings. How do you do this? Well, we find the net income using the sales and cost information, and then we subtract out any kind of dividend that we must pay. And that dividend information comes from the dividend payout constraints. Then we need to find the percentage increase in assets needed to support the new sales level. If we are fully utilizing our capacity, then this percentage increase will just be the same as the percentage increase in sales. However, if you are utilizing less than 100% of your capacity, then it will be less than the percentage increase in sales. And you can go back to example 5 to see how we find the percentage increase in assets that are needed to support this new sales level. Then we need to find the external financing needed by subtracting out the old debt level, the old equity level, and the new addition to retained earnings from that new asset level. Finally, we're going to use our capital structure constraints to determine whether EFN should be satisfied with debt, equity, or both. Now let's talk about external financing needed and how it impacts growth. We calculate two growth rates. The first is called the internal growth rate. That one tells us how fast the company can grow on internal equity alone. What do we mean by internal equity? That's the new addition to retained earnings. That's the portion of net income that we did not pay out as a dividend. The sustainable growth rate tells us how fast the company can grow on internal equity and the right amount of debt to keep the debt to equity mix of the capital structure the same. As an example, if we have a debt to equity ratio of 1, that means for every dollar of debt, we have a dollar of equity. In order to maintain that, for every dollar of addition to retained earnings that we have that adds to our equity, we have to take on an additional dollar of debt. Otherwise, we wouldn't be keeping our debt to equity mix the same. Here's how we calculate the internal growth rate. We start with ROA, which is return on assets, and we multiply that by B. B is what's known as the retention or plowback ratio. This is the percentage of net income that is reinvested in the firm. We can calculate that as addition to retained earnings divided by net income. B is also 1 minus the dividend payout ratio, because after all, if it's not paid out as a dividend, it becomes addition to retained earnings. We'll need the product of ROA and B again in the divisor. So when I calculate this product, I always put it in the memory of my calculator. For the bottom, we take 1 minus that product, so you just need to recall that number from your calculator. What we wind up with is a decimal that we can convert to a percentage by multiplying by 100. This represents the percent growth rate in sales that we can support using internal equity only, assuming full capacity utilization. The formula for sustainable growth rate looks quite similar, only instead of having ROA, we have ROE. Everything else is identical. What's the relationship between ROE and ROA? Recall that ROE is simply ROA times the equity multiplier. What does a sustainable growth rate mean? That's the rate at which you could grow sales assuming full capacity on internal equity alone and enough debt to maintain a constant debt to equity ratio. Sustainable growth rate is going to be higher than internal growth rates for all firms that have any debt whatsoever in their capital structure. Why? Internal growth rate depends solely on addition to retained earnings. Sustainable growth rate also brings in debt from the outside for any firm that has debt in their capital structure. So what impacts the internal growth rate and the sustainable growth rate? Profit margin impacts both, because higher profit margin means higher ROE and higher ROA. The more money you make on your sales, the more net income you have, the more money you have to plow back into the operation. Also, total asset turnover. The more sales you create for the same assets, the smaller asset base you'll have to grow, and the more net income you'll have per asset. Your dividend policy also impacts both IGR and SGR. Think about this. If you pay out all of your net income as a dividend, how much do you have left in addition to retained earnings? The answer is none. There's no internal equity. Therefore, sustainable growth rate and internal growth rate would both be 0. But as we start paying less than 100% of our net income as dividends, addition to retained earnings increases. As addition to retained earnings increases, our plowback ratio increases, and as our plowback ratio increases, both sustainable growth rate and internal growth rate increase. And then finally, for sustainable growth rate only, our financial policy matters. In other words, our capital structure. The more debt you have in your capital structure, the higher your sustainable growth rate will be. Why? Because for the same dollar of equity, you're adding more debt for a firm that already has a higher proportion of debt in its capital structure. Okay, I want to leave you with a few thoughts. First of all, don't make the mistake of thinking that the sustainable growth rate is the fastest rate at which the company can grow. You could take on additional debt and not worry about maintaining your capital structure. And so you could keep the same amount of equity and grow purely with debt, and you would end up growing faster than the sustainable growth rate. You could grow on internal equity plus massive amounts of external debt. If you wanted to maintain your debt to equity ratio, that's still possible. You could issue external equity in addition to borrowing money from external sources. So don't be confused and think that the sustainable growth rate is the fastest rate at which the company can grow. The next thought I want to leave you with is that external financing needed is one of the toughest topics for students. And so what I would encourage you to do is to work through these examples over and over again, watch the lectures over and over again, until you feel comfortable that you understand the process. And you might even make sure that the steps for the process that I put in the summary are handy when you take the exam.